Hello and welcome to Xperience Realty. My name is Tarun. In my line of work as a property consultant, I hear this refrain all too often. I was advised by a consultant to invest in Dubai in 2025, but I was not ready. Well, that scene has already played out. The tide of opportunity has rolled on and it has taken with it the significant upside that rewards perfect timing. But every story has a villain. And in this case, it was not the market, it was not the timing, it was the quiet pantomime villain that no one notices until the curtain falls. It was the lack of preparedness. It's 2026 now, and if you are sitting on the fence, still undecided, then consider this as your reset, a second wind, an opportunity to reposition and move forward intelligently with intent and not hindsight. Because Dubai real estate market in 2026 holds opportunities which will be the catalyst for generational abundance. So let's start this year by sharpening the saw so that we move ahead with knowledge, clarity, and conviction. And on this note, without much ado, let's look at the opportunities, some of the most transformative opportunities that are available in Dubai real estate market in 2026 at your beck and call. Affordable housing. Affordability is inherently relative. What is attainable for one household may be aspirational for another. Yet, the broader challenge in Dubai's housing market is clear. While the average residential prices across the city have risen by approximately 65%, income growth has not kept pace. If Dubai is to meet its population target of 7.8 million residents by 2040, a sustained pipeline of housing across a wide range of price points will be essential. However, the supply outlook suggests increasing constraints of the housing stock, the total housing stock that is currently planned or under construction and due for delivery in 2029. Approximately 92% is expected to be priced above 1,000 dirhams per square foot. Now, a commonly used benchmark for defining affordability is around 1,000 dirhams per square foot. Now, this underscores the scale of the emerging imbalance. Market activity within the sub 1 million segment further reinforces this trend. Between Q1 and Q3 of 2025, listings in this price bracket declined by 14% compared with the similar period last year, while transaction volumes have increased by 10%. In other words, demand is strengthening precisely as supply is contracting. The economics of development have explained this divergence. Since early 2021, land values have increased nearly threefold, while labor and construction costs have approximately doubled. In this context, delivering genuinely affordable housing has become structurally challenging. As a result, only 8.4% of the total apartment transactions during Q1 and Q3 of 2025 occurred below the 1,000 dirham per square foot threshold, reflecting a development pipeline increasingly skewed towards luxury and ultra-luxury end products. Even so, apartments across the city remain broadly affordable by global standards. Villas, however, are becoming progressively out of reach for many households. Since 2020, the number of neighborhoods where 4-bedroom villas require income levels exceeding 6 times rather, has doubled. So, from 10, these communities have gone up to 20, highlighting the growing affordability gap in this segment. To illustrate the current conditions, an average 1,000 square foot apartment, typically a 2-bedroom, unit now implies a purchase price of approximately $1 million. Assuming a 20% down payment and a mortgage lending at 5 times the annual income, a domestic buyer would require an annual income of around 160,000 dirhams, which is approximately 27% lower than the prevailing citywide average income multiple. Okay, now looking ahead, the prospect of new sub 1,000 dirhams per square foot development in well-located areas appears to be increasingly limited. As a result, what you will see is, with the affordability pressures which will persist, the investment opportunities will shift towards emerging districts with proximity to established urban infrastructure, like urban centers, and existing planned transit-oriented infrastructure. Such locations with constrained future supply and sustained end-user demand have the potential to translate into durable long-term upside. So, focus on developments which are in close proximity to existing urban centers. Okay, proximity might be close, might not be close. These communities or these developments will offer you an immense upside. Okay, so going forward in the future, the notion of the sub 1,000 dirham per square foot development in Dubai is going to be very challenging to come by. In lieu of that, the next price segment where you should be targeting to invest into would be the 1,200 dirham per square foot bracket. And this is where there will be a tremendous upside, because as the city grows, the population grows, we need to provide housing across a varied spectrum. So affordability and affordable housing going forward in 2026 will be a segment which represents a massive opportunity. The next opportunity is beachfront villas and plots. Beachfront villas and plots feature predominantly in today's opportunity set, not because of the tired argument of the finite shoreline or the borrowed nostalgia from the legacy developments. Their relevance is far more compelling. Waterfront and beachfront developments sit at the very heart of Dubai's long-term vision. As the city works towards doubling its population by 2040 and positioning itself among the top 3 tourism destinations in the world, its ability to attract residents and millions of visitors will hinge not merely on housing supply, but on iconic destinations supported by entertainment, world-class hospitality, vibrant F&B ecosystem, seamless connectivity, and globally recognizable attractions. In this context, beachfront real estate is not a speculation. It is an infrastructure-adjacent asset class. You are not buying into a scarcity story. You are investing in real demand, underpinned by demographics, global capital flows, and long-term urban momentum, the true engines of ROI and enduring value. It is also important to acknowledge that Dubai can, whenever required, create new shoreline through land reclamation. Developments such as Naya Island, where Cheval Blanc is delivering just 30 ultra-exclusive villas, and Asora Bay, which transformed underperforming land into high-value beachfront destination, demonstrate this capability. Yet, both projects share a critical common thread. Developers today are struggling to meet the increasing demand for beachfront villas. According to Knight Frank Destination Report Dubai, 74% of global high net worth individuals prefer beachfront homes, with golf course villas distant second at 17%. This demand dynamic has materially reshaped the supply. New beachfront developments are increasingly becoming small scale and highly exclusive, as smaller projects allow faster execution and preserve the pricing power. At the same time, with labor and construction costs having doubled, replicating the mega projects of the scale of Palm Jumeirah and Dubai Islands or Palm Jebel Ali has become increasingly and economically prohibitive. The result is structural supply discipline, not by design, but by cost reality. The investment case for plots is equally compelling. Today, acquiring plots directly from developer is virtually impossible. Due to the lack of availability, there are no plots available with any developer, beachfront plots. More importantly, plots have historically appreciated in line with ready villas, while offering superior downside protection. A Palm Jumeirah plot acquired in 2011 for a mere 39.67 million dirhams, later in 2025 transacted at 365 million dirhams. The same price achieved by a ready villa on the same location. Now, in a market, if there is a downturn, plots also have demonstrated shallower corrections than completed villas, creating a rare asymmetry, comparable upside with reduced downside risk. Now, you can understand that if I buy a ready villa and if there is a downturn or a correction, I stand to lose substantially. But in the case of plots, my loss is curtailed. So, you have the best of the result in the event of a strong market, but in the event of a correction, your investment is safeguarded, which makes the case for plots more compelling. Having understood how plots will safeguard your investment and at the same time they will lead to exponential growth, we need to come back to the availability of beachfront villas. Now, turning to the availability, if we look at what is there in Dubai today, it is very important to understand that, Palm Jebel Ali, where Nakheel launched the villas, there are around 2,002 villas in total. Out of that, Nakheel has already managed to sell 1,758. The remainder will be sold at some stage later on, okay? Similarly, then we move on further along the coast, we come to Palm Jumeirah, which today has around 1,458 ready villas and another 75 under construction. Similarly, when we move further this side, we have Bulgari Islands, which has around 148 plots for beachfront villas and ready villas as well, okay? 148 is including both of them. And I'm being very generous. I'm not just counting these villas which are in direct access to the beach, because that ways Bulgari Islands will have fewer villas. So 148 from Bulgari Islands. Then we move on further to come to La Mer South, which again has around 140 beachfront villas, okay? Similarly, Pearl Jumeirah, if I count the literal beachfront villas, there is only 28 of them, but I would give the benefit of doubt and I will say there are 300 beachfront villas in Pearl Jumeirah as well. We're talking about beachfront developments broadly, yeah? And then we move on to Dubai Islands, where Nakheel already launched around 640 villas on Island B, okay, which was Bay Villas. And Island E is nearing a launch where they will be launching another 150 villas. So this is by and large the broad availability of genuine beachfront developments in Dubai. Now, if you do the total, you are talking about only 5,500 odd beachfront villa community or developments available in Dubai. Now, I say that this scarcity must be viewed against Dubai's macro trajectory. At the current pace of millionaire migration, Dubai is on track to become the largest millionaire hub in EMEA by 2040, overtaking traditional centers such as London, Paris, Milan. Compounding this is the family formation rate, which at 7.8% last year, materially is higher than the city's population growth of 5.6%. Further reinforcing the sustained end-user demand for large lifestyle-oriented homes, particularly beachfront villas. Now, historic performance also validates this thesis beyond a shadow of doubt. Over the past 5 years, Palm Jumeirah has grown by 193%. At the same time, Bulgari Islands grew by 213%. And I was at wit's end when I saw the growth in Pearl Jumeirah, where prices in 2020 were at almost around 550 dirhams per square foot. They have gone up to 2,890 dirhams per square foot, which we are looking at a 425% increase. At the same time, Lamer South during the same time grew by 268%. Now, these outcomes are not a product of leverage or speculation, but persistent demand colliding with structurally constrained supply. Consider Asora Bay in this light. Priced approximately at $2,500 per square foot, it sits meaningfully below comparable global cities that rank below Dubai on the GPCI Power Index, where similar assets transact closer to $4,000 per square foot. The convergence potential is evident, okay? Likewise, Palm Jebel Ali and Dubai Island villas trading at around $900 per square foot are priced at a clear discount compared to global beachfront benchmarks. As infrastructure, lifestyle ecosystems and end-user demand mature, repricing towards $2,500 per square foot is not aspirational. It is only structurally supported. The fundamentals for beachfront development are firmly in place. Supply is finite in practice, demand is accelerating, and capital continues to migrate forward towards lifestyle-driven coastal assets. At this stage, the only variable that remains is investor timing. And you in 2026 are at the gateway to acquire a splendid beachfront home at a discounted price in this city, which aims to be the #1 in the world by 2040. So off we go now to our next opportunity. The next segment that we'll focus on will be wellness. If there is one trend poised to future-proof your investment in Dubai and increasingly across the world, then it is none other than wellness. As the world prepares for a historic intergenerational wealth transfer of approximately $84 trillion from baby boomers to the younger cohorts, the shift will not only redefine who controls capital, but also how that capital is deployed. Knight Frank's Next Generation survey reinforces this transition, revealing that amongst the affluent 18 to 35 years old, real estate ranks as the most desired luxury asset, underscoring its enduring relevance across generations and wealth tiers. The post-pandemic period has further accelerated this evolution. Traditional symbols of wealth such as watches, cars, have declined by around 2% in dollar terms, while priorities such as longevity, meaningful experiences, and time well spent have moved decisively to the forefront. This recalibration is now reshaping residential design itself, where prime real estate, which was once defined by postcodes and Picasso-worthy proportions, today's discerning homeowners seek environments that actively support health, vitality, and long-term well-being. The shift has given rise to a new wave of developments globally and particularly in Dubai, where wellness is embedded as a core principle rather than an amenity. These projects integrate advanced wellness technologies, curated treatments, and restorative rituals at their very foundation. Complementing this are the green biophilic design philosophies, expansive parks, nature trails, and gardens, robust fitness infrastructure, and dedicated mind-body spaces such as yoga decks and meditation zones, high air quality, abundant natural light, community well-being programs, holistic lifestyle amenities including spas, recovery areas, and seamless access to nature collectively elevate wellness from a feature to a way of life. From an investment perspective, the supply-demand dynamics are equally compelling. Dubai is expected to deliver only 18,000 wellness-oriented homes between 2027 and 2030, positioning wellness real estate as one of the most supply-constrained segments of the market. Globally, the wellness economy is expanding at an average growth rate of 8.6% annually, significantly outpacing IMF's projection of 5.1% for the global GDP growth. More notably, wellness real estate has grown approximately at 19.5% over the past 5 years, far exceeding traditional construction growth, which roughly grew by 5.5% between 2019 to 2024. These metrics point to an asset class demonstrating both superior growth and structural resilience. Crucially, this momentum is reinforced at the policy level. Dubai's long-term government agendas, including Vision 2040 and the Dubai Economic Agenda D33, place quality of life, sustainability, active living, and well-being at the core of urban and economic planning. The ambition to rank among the world's top cities for livability by 2033 is underpinned by investments in healthy communities, connectivity, culture, and lifestyle infrastructure, precisely the pillars that support the rise of wellness-led real estate. Taken together, the demographic shifts, evolving lifestyle preferences, constrained future supply, superior growth metrics, and direct alignment with government strategy, wellness real estate is not a passing trend, but a structural evolution in how value is created and preserved in property market. This is an asset class built not only for the next cycle, but for the next generation. So an investment into the wellness bandwagon, which is stream rolling, is a prospect that in 2026 can catapult your fortunes to the next level. Now we explore the next investment opportunity in Dubai. The next opportunity will be villas. Villa prices have risen by 66% from 2014 levels, and the underlying demand dynamics explain why this segment continues to outperform. Although villas and townhouses account for just 33% of the total rental transactions, they generate a disproportionate 58% of the total rental value. A clear indication that the scarcity of larger family-oriented homes is driving the rents and the prices upwards at a far faster pace than the wider market. This imbalance becomes even more compelling when we view this through the lens of household formation, which in 2022 grew by 8.5%, 8.1% in 2023, and 7.8% in 2024, consistently outpacing the performance or the population growth, which hovered around 5.8%. Now, with an average family size of 4.2 as per Dubai Statistics Center and approximately 795,200 households recorded by the end of 2024, nearly 3.39 million people out of Dubai's 3.86 population in 2024 were living in family units, meaning families accounted for 86% of the total population of the city. The convergence of accelerating household formation, and sustained price appreciation has firmly positioned villas as the most sought after residential segment in Dubai. And with only 160,852 villas in 2024, again as per Dubai Statistics Center, and only 63,000 new units to be added until 2029, you are looking at 223,852 units with a projected population of 4.95. So based on the demographics of population and the prospect of growth, ignore this segment and you wash your hands of a sure shot winner. So villas in 2026 will be your key to superlative and exponential capital appreciation, which will translate into massive rental returns as well in the future, because this city is going to face a scarcity or a major shortage of villas in the future. And with the family formation happening, no points for guessing, it is the larger layouts which will be preferred. So you are talking about the 4 and 5 bedrooms, where the 4 bedrooms in 2025 commanded a 31% of the market share, and 5 bedrooms followed in closely at 29%. 3 bedrooms also represent an amazing opportunity, but collectively the 4 and 5 bedrooms, which are the larger layouts, outpaced the 3 bedrooms, which on their own were around 32% of the total sales transactions that happened in 2025. Now, given the clear preference for larger layouts, given the clear preference for communities, you are set for some of the most exciting launches in this segment which are going to come by. So be vigilant, be aware, and if you have the means, by all means, go and buy a villa in Dubai in 2026. Now, we will explore another segment which represents a plum of an opportunity. Why? And as you understand, my narrative is not based on scarcity or the limited availability. It is always governed by demand, which is the true indicator of ROI, because demand and returns are directly related. So off we go to explore our new opportunity. The next segment that we're going to cover is branded residences. According to the latest Knight Frank Destination Dubai report, 86% of the global high net worth individuals intend to purchase a branded residence in Dubai, which is up sharply from 69% in the last year. Demand is the strongest among Saudi investors at 92%, followed by Indians at 88%, the East Asians at 81%, with UK at 78% showing comparatively lower but still significant interest. Importantly, intent to purchase rises materially with the wealth. Among the individuals with a net worth of $1 to $5 million, 34% express strong likelihood of buying a branded residence in Dubai in 2026. This figure climbs to 75% for those with a net worth of US $50 million and above, underscoring this segment's deep alignment with ultra-high net worth demand. At its core, the appeal of branded residences is lifestyle-led. These assets offer access to a curated living experience, premium service, professionally management environments that encapsulate the Dubai dream. The assurance of global standard property and facilities management, combined with rental optionality, further strengthens their appeal for both residents and internationally mobile capital. Market pricing validates this demand. In Dubai, branded residences command an average premium of 115% over the mainstream residential market, far exceeding the global average premiums of 35 to 40%. This differential reflects both the strength of demand and the scarcity of high-quality, globally branded supply. Buyer motivation further reinforces the maturity of this cycle. Knight Frank data indicates that 61% of high net worth individuals purchase branded residences primarily for personal use rather than speculative resale. Within this cohort, 23% intend to make the property their primary residence. 21% view the property as their secondary or a holiday home, and 16% plan to use it as a retirement residence. This shift from short-term speculation toward long-term, lifestyle-driven ownership marks a structurally healthier demand profile. Dubai's position as the branded residence capital of the world is therefore grounded in fundamentals, not sentiment. Despite the strong developer interest, supply remains tightly constrained. There are currently only 18,100 branded residential units in existence, with only 30,374 additional units expected by 2029. And even if all the planned projects are delivered on schedule, branded residences would still make up only for 4.06% of the total residential inventory by the end of the decade. These dynamics are reinforced by the broader wealth trends across the globe as well. Dubai is now home to approximately $86,000 millionaires, 251 centimillionaires, and 23 billionaires, which reflects UAE's success as a destination that is attracting global wealth. In parallel, the global wealth creation remains robust. In 2024, the population of individuals worth above $10 million grew by 4.4%, hitting 2.3 million, while the population of those who were worth $50 million and above grew by 4.2%, surpassing 100,000 for the first time. Now, Knight Frank's wealth sizing model projects this growth to gain more momentum, where those individuals who are worth $10 million and above would exceed 2.5 million by 2028, and those worth 100 million and above would surpass 110,000. Against this backdrop, the supply remains very selective. Of the total 352,000 residential real estate units scheduled for delivery by 2029, only 13,000 fall within the 3,000 to 5,000 dirham per square foot range, which is typically associated with branded residences. With an average branded residence price of 3,853 dirhams per square foot, this segment sits squarely at an intersection of constrained supply and expanding global demand. Performance data confirms the resilience of this asset class. Between 2020 and 2024, Dubai's branded luxury apartment segment recorded an 1,100% growth in sales volume, from 104 transactions to 1,253 transactions. A 1,400% growth in sales value, from a mere 1.8 billion all the way until 27.4 billion, and a whopping 75% increase in average price per square foot, from 3,015 dirhams per square foot to 5,281 dirhams per square foot, which is a higher growth rate than the average market, These outcomes reflect demand-led aspirational growth rather than leverage-driven speculation. Finally, the composition of supply further clarifies the buyer preference. The branded residences landscape in Dubai is dominated by hospitality-led brands, which comprise 80% of the total inventory, closely followed by the fashion-related brands, which are on 17%, and the automotive brands, which consist of 3% of the total inventory. In absolute term, this equates to 91 branded hospitality projects, 18 fashion branded projects, and only 5 automotive branded developments, confirming a clear market preference for professionally operated, service-oriented residential experiences. Taken together, the convergence of global wealth expansion, end-user-led demand, tightly constrained supply, and demonstrated price resilience, positions branded residences as one of Dubai's most compelling real estate segments in 2026 and beyond. Yes, branded residences may sound cliched, but this is the way forward. Last but by no means the least, in 2026, Dubai's office market has decisively shifted from a cyclical recovery story to a structural, policy-backed investment thesis. Since the introduction of 100% foreign ownership and long-term residency reforms, Dubai has attracted 44.8 billion dirhams in greenfield FDI projects between 2021 and 2024, ranking first globally for 4 consecutive years. This has driven an unprecedented surge in business formation, with approximately 990,000 registered companies serving just 4 million residents, one of the highest businesses per capita worldwide. For mainland companies, this demand is a non-negotiable. Ejari registered office space is a legal prerequisite to obtain and renew a trade license, mechanically converting company growth into office absorption. The quality of the demand has also materially upgraded, with over 138 Fortune 500 firms establishing or expanding regional headquarters in Dubai, accelerating a clear flight to Grade A institutional quality office space. As a result, Grade A occupancy today stands near 98%, while office transaction volumes rose by 88% and transaction values have surged by 240% between 2021 and 2024. Prime rents in DIFC reflect a tightening demographic, up 96%, Sheikh Zayed Road up 22%, Business Bay up by 18%, placing Dubai amongst the world's most expensive prime office markets. Yet, supply remains misaligned. Only 24% of the upcoming monitored stock is LEED certified, despite LEED certified buildings achieving 34% rental premiums, 12 to 15% annual returns, and 45 to 55% capital appreciation over the last 5 years. With future supply phased increasingly towards the build-to-rent model and concentrated in limited zones, 2026 represents a critical entry window where owning certified Grade A office positions investors ahead of a widening two-tier market that will increasingly reward quality, compliance, and institutional relevance. So, certified office spaces are the way forward if you're looking at investing in Dubai. To conclude, real estate rewards persistence, vision, and long-term strategy. So if you are someone who has the ambition, intent, and the desire to own trophy assets and generational holds, the true crown jewels of any portfolio, then do feel free to reach out. And if this video added value to your pursuit, then do feel free to like, share, and subscribe to show the love. This is Tarun saying sayonara until then.